Hey everyone, we're diving into the State Bank of India today. I know a lot of you are interested in their stock, and I've got to say, the data from Screener, this stock analysis platform, is pretty fascinating. We're talking about SBI, a 200-year-old institution.
Wow.
It's also a Fortune 500 company and the biggest bank in India.
That's a lot to unpack.
Yeah, it is.
SBI plays such a huge role in the Indian economy, so understanding how they're doing is about way more than just stock prices, right?
Yeah.
It kind of gives us a peek into the country's financial health as a whole, and we've got some pretty interesting details here, stuff that I think might surprise you.
Yeah, for sure. We're talking about like massive contingent liabilities, and we're going to get into a time when their profit margins actually went negative.
Yeah.
But first, let's look at where things are at right now as of November 19th, 2024. SBI stock is sitting at 803 a share, a little dip of 1.39% for the day. Market cap is huge, 7,016,647 crore,
Wow.
which for those of us who don't work with crore all the time, that's over 900 billion US dollars.
That's right. And their PE ratio, it's at 9.36. Seems like investors are kind of cautiously optimistic about their future earnings, but here's what's really interesting. Over the past 5 years, SBI has grown like crazy, with a profit growth rate of 98.7% CAGR.
Wow.
That kind of growth usually means a company's doing well, but there's something a little off. Their interest coverage ratio is kind of low.
A low interest coverage ratio. Sounds like a bit of a red flag, maybe.
Hmm.
What does that mean exactly? What's it telling us about how SBI is doing things?
Well, it could mean they're borrowing a lot to finance all that growth, kind of like building a bigger house with a lot of borrowed money. You might have this great property, but you've got this huge mortgage hanging over you.
Oh, I see.
Not necessarily a bad thing, but definitely something to keep an eye on, especially if, interest rates climb or if their earnings take a hit.
Okay, so we're seeing some risk mixed in with all that fast growth. And then there's that other number that's making me a little nervous. Those contingent liabilities. 24,065,418 crore. I don't even know how to say that. But seriously, what could happen with a number that big? Could this be a huge problem for SBI down the road, or are we, like, overreacting?
Well, let's not say huge problem just yet, but yeah, contingent liabilities can be kind of like a shadow hanging over the balance sheet. Basically, it's a promise to pay if certain things go south. It's like co-signing a loan for a friend. If your friend can't pay, you're stuck with the bill. For SBI, if a lot of these contingent liabilities were to actually happen, it could really stretch their resources, right?
For sure. So is this level of risk normal for a bank like SBI? Or is there something different going on here?
That's a great question. To answer it, I think we got to zoom out and look at the whole Indian banking sector. Banks in emerging economies, they often have bigger contingent liabilities because of things like government guarantees or being involved in big infrastructure projects. So while the number is big, it might not be totally unusual compared to other banks like them, but definitely something we got to watch as we dig deeper into SBI's story.
Okay, let's keep following this trail. Let's focus on how SBI has been doing each quarter. Their revenue, interest, and financing margins have been all over the place, haven't they?
Yeah, kind of like a roller coaster.
Yeah, from September 2021 to the projections for September 2024, it's a wild ride.
Definitely. And there are even times when they had negative financing margins. Like in March 2022, it was negative 26%. Now, that really makes you wonder what was going on. It means that sometimes SBI's cost of getting money was actually more than what they were making from their loans.
Yeah.
That's not something you can do forever, So what was happening there?
Yeah, negative margin.
Yeah.
It's almost like they were losing money on every loan. What could cause that? Were they making like super risky loans, or was it something else?
There could be a few things happening. Maybe it was because of changes in the interest rates set by the Reserve Bank of India. Or maybe competition in the banking sector was getting tougher, so SBI had to lower their lending rates to attract customers. Or maybe they made a strategic choice to go for certain types of loans that have lower returns at the beginning, but could be more profitable later on.
Interesting. So it might not necessarily mean they were making bad choices, but we definitely got to look into it more. Let's step back a bit and look at SBI's profitability over the long term. We have data all the way back to March 2013, and it shows some big swings in their profit before tax. And then there's this weird thing, a negative profit margin of negative 38% back in 2018. That can't be good, right? What was happening in India, or within SBI itself, that could explain such a dramatic downturn.
Yeah, that's a huge dip, and it lines up with a pretty rough time for Indian banks in general. There was this surge in bad loans, loans that weren't being repaid. It hit a lot of banks, including SBI. It's very likely that this wave of defaults is what caused their negative profit margin back then. But what's amazing is how SBI has bounced back since then. It really shows how adaptable they are, how they can roll with the punches and come out stronger.
Resilience is the word. So we're looking at a bank that's seen its share of good times and bad times. Before we dive into the nitty-gritty of their profit and loss statement, I got to ask, what does all this up and down stuff tell us about SBI as an investment? Is it super risky, or is this just how things go in the banking world?
That's the big question every investor has to wrestle with, isn't it? Volatility can be scary, but it can also be a chance to make some money. SBI's history shows they can handle tough situations and come out on top. But it's super important to understand the risks and the potential rewards before you make any decisions. Let's get into these numbers and see what else we can find out.
Okay, I'm ready to get into the details. Let's unpack this profit and loss section and see what stories these numbers tell us. I'm really curious about those times of huge growth and also that dip in 2018. Was that a one-time thing, or is there a pattern we need to be aware of?
Let's take a look. When we look at SBI's compound sales growth over the past 10 years, we see a steady 9% growth.
Okay.
But get this, over the past 5 years, it jumps to 12%. And over the last 12 months, it's a whopping 18%.
That's a big jump. It seems like SBI is really on a roll lately. But what's driving that? Is it just India's overall economic growth, or is SBI doing something special to grab a bigger piece of the market?
It's probably a mix of both. India's economy has been doing well.
Right.
And SBI being the biggest bank in the country, they're naturally going to benefit from that growth. But they've also been making some smart moves, like expanding into digital banking and going after those rural markets.
So they're not just riding the wave, they're actually paddling too. That's good to see. Now, what about their profit growth? We saw that amazing 5-year CAGR of 99%. Can they keep that up?
Well, the last 12 months show a profit growth of 12%, which is still good, but definitely slower than before. Investors are going to be watching closely to see if this is just a temporary thing or if something bigger is changing.
Okay, so the profit growth is still positive, but maybe not as amazing as it was a few years ago.
Yeah.
What could be causing that slowdown? Is it just tougher competition, or are there other things SBI is up against?
Well, competition in Indian banking is getting fierce, that's for sure.
Yeah.
Both private and public sector banks are fighting for customers. But we also have to think about things like rising interest rates and inflation. Those can really squeeze profit margins.
Yeah, that makes sense.
Yeah.
Higher costs for SBI could mean lower profits, even if their sales are strong. Now let's talk about the stock price. Over the last 10 years, the stock price CAGR has been a respectable 10%.
Right.
But once again, we see a huge jump in recent years, reaching an incredible 43% in just the last year alone.
It's interesting how the stock price CAGR is actually growing faster than the company's sales and profit growth lately. It seems like investors were getting really excited about SBI's future, maybe betting that they could keep up this high growth.
So it seems like investors are willing to pay more for SBI stock, even though their profit growth has slowed down a bit. Could this be a sign that they're overestimating SBI's potential, or do they see something in these numbers that we're missing?
It's possible investors are considering other positive factors, things like SBI's strong brand, their huge network of branches, and the fact that the government backs them.
Right.
These things give investors a sense of stability and trust.
That's a good point. Sometimes the numbers don't tell the whole story. Now let's look at SBI's return on equity. It's been steadily climbing over the years, from 9% a decade ago to 13% 5 years ago, and now it's at a solid 17%. That's pretty impressive, isn't it?
It really is. ROE is a key metric for investors. It shows how well a company is using their shareholders' money to make profits. And the fact that SBI's ROE is going up is definitely a good sign. It means they're getting better at making money for their investors.
So even with some of the challenges we've talked about, SBI seems to be doing a good job of giving their shareholders solid returns. Now, I know we can spend all day talking about the profit and loss section, but we've got balance sheets, cash flows, and a whole bunch of ratios to look at too. Before we move on, I'd like to hear your overall take on SBI's profitability based on what we've seen so far. Are they a profit machine, or are there some cracks starting to show?
I wouldn't say profit machine just yet.
Okay.
They've definitely shown strong profit growth, but there are some signs that it's slowing down. The big question is, can they keep making good profits as they deal with things like more competition, rising interest rates, and those contingent liabilities we talked about?
All right, good point. It seems like SBI's profitability is a bit of a mixed bag. They're definitely capable of making good money, but there are some potential problems to watch out for. Now let's switch gears and look at the balance sheet. This is where we get a snapshot of SBI's assets and liabilities, which gives us a clearer picture of their overall financial health. Are there any red flags jumping out at you right away?
Well, one thing that pops out is how much SBI's total assets have grown over the years.
Okay.
From 2,132,514 crore in March 2013 to a projected 6,733,756 crore in March 2024.
Wow.
That's more than 3 times bigger. Now, growth is usually a good thing, but we need to understand how they're paying for all that growth and if it's sustainable.
That's a huge increase in assets. It makes me think back to that low interest coverage ratio we talked about earlier.
Sure.
Are they borrowing too much to fuel this expansion? And is all this growth putting too much strain on their balance sheet?
Those are important questions. And to answer them, we need to look at what makes up SBI's assets and liabilities. It's not just about the total size, but also about the quality of those assets and how risky they are. For a bank, a lot of their assets are loans. So the quality of those loans is really important. If a lot of those loans go bad, it could weaken SBI's financial position.
So we're not just looking for growth. We're looking for healthy growth.
Right.
Now, as we dig deeper into the balance sheet, what specific areas should we focus on to understand SBI's asset quality and how well they manage risk?
One key area is non-performing assets, or NPAs.
Okay.
These are loans that aren't being repaid like they're supposed to.
Right.
A lot of NPAs can be a warning sign.
Yeah.
It could mean there are problems with how they're giving out loans or that the economy is getting worse.
So we need to keep an eye on those NPAs. What else should we be looking for in the balance sheet?
Another important area is the capital adequacy ratio. It basically measures how much money a bank has in reserve compared to the risks they're taking. Regulators set minimums for this ratio to make sure banks have enough of a cushion to handle financial shocks.
Okay, so we're looking for a balance sheet that shows good quality assets, enough reserves, and a manageable amount of debt. Now let's move on to the cash flow statement. This is where we see the actual money coming in and going out of the business. What are some of the key things we can learn from SBI's cash flow statement?
The cash flow statement tells us a lot about how well a company can generate cash from its operations, invest in its growth, and manage its financing. For a bank like SBI, we want to see strong and steady cash flow from its core business.
Right.
It shows they're making enough money to cover their expenses and pay their debts.
Right. It's not enough to just have profits on paper. We need to see those profits turning into real cash.
Now, looking at SBI's cash flow statement, we see some ups and downs in the net cash flow from operations. Some years it's positive, others negative. What does that mean? Seeing some ups and downs in cash flow from operations isn't that unusual, especially for a giant bank like SBI. It's affected by all sorts of things, like changes in interest rates when they give out loans and how much money people are depositing. What's more important is to look for patterns over the long term.
And it looks like SBI has been able to make positive cash flow from its operations in most years, which is good. But those times when it was negative make me wonder, are they investing enough in their future growth? Are they maybe relying too much on short-term borrowing to manage their cash flow?
Those are really good questions. We'll have to look at their investing and financing activities to understand how they're using their cash. Are they putting money into new technologies, expanding their branches, or buying other businesses? And how are they paying for all of this? Are they using debt, issuing new shares, or using the cash they're making from their operations?
Okay, so there's more to it than just the net cash flow from operations. We need to look at the bigger picture to see how they're investing and financing their business, to figure out if they're financially sound in the long run. Now, before we get into those details, I'm curious, what are some red flags you look for in a company's cash flow statement? Are there any warning signs that would make you hesitant to invest, even if their other financials look good?
One big red flag is when there's a growing difference between a company's net income and the cash flow from their operations. If a company says they're making big profits, but they're struggling to actually generate cash from their main business, it could mean they're playing games with their accounting, or that their business model isn't sustainable. Another warning sign is when a company relies heavily on debt or selling new shares to cover their day-to-day expenses. That could mean they're not making enough money from their core business to pay their bills, which isn't good in the long run.
Those are good points to remember. It reminds us that cash is king, and we need to look beyond just the accounting numbers to really understand how healthy a company is financially. Now let's focus on SBI's investing and financing activities. What can we learn here about their growth strategy and how they manage their money?
Let's start by looking at their investments in things like property, plant, and equipment. It's often called capital expenditures or CapEx.
Okay.
This will show us how much they're putting into expanding their physical infrastructure, like branches and
All
ATM.
right, so we're looking for signs that SBI is investing in its future, not just trying to squeeze every last rupee out of what they're already doing. What else should we be looking for in their investing activities?
We should also look at how much they're investing in intangible assets, things like software and technology. This tells us if they're keeping up with the times and putting money into innovation so they can stay competitive in this fast-changing world of banking.
That's a really important point. Banks can't just rely on those physical branches anymore. They have to be leaders in digital banking if they want to keep their customers and attract new ones. Now let's talk about their financing activities. This is where we see how they're getting the money to fund their operations and investments. What are the key things we should focus on here?
We need to look at their debt levels and how they're managing that debt. Are they borrowing too much? Can they refinance their debt at good rates? And are they using debt strategically to make more money for their shareholders?
Debt can be tricky, right? If you use it wisely, it can help you grow and make more money. But too much debt can be dangerous, especially if interest rates go up or if a company's earnings drop. What else should we think about when we're analyzing SBI's financing activities?
We should also look at their dividend policy. Are they paying out a reasonable amount of their earnings to shareholders? Are they using dividends to attract investors? And does their dividend policy make sense with their overall financial strategy?
So we're looking for a balanced approach to financing, using a mix of debt and equity in a smart way to fund their growth while also rewarding their shareholders with dividends. Now, before we move on to the ratio section, I have a question about SBI's ownership structure. We know they're a public sector bank, which means the government owns a big chunk of it. How does that affect their financial decisions and their overall strategy?
That's a great point. Government ownership can have its advantages, things like stability, easier access to funding, and political support.
Right.
But it can also cause problems like bureaucracy, political interference, and a potential clash between making money and achieving social goals.
So it's a bit of a tightrope walk. SBI needs to be a successful business, but they also have to think about the needs of the Indian economy and its people. Now let's look at the shareholding pattern. This will tell us exactly who owns SBI, and it can give us valuable clues about investor sentiment and how much influence different shareholder groups might have.
Absolutely. Understanding who owns the company can help us see how decisions are made and who has the power. It's like looking at the boardroom and seeing who's sitting at the table and how much say they have.
Okay, I'm ready to meet the players. Let's see who's running the show at SBI and what impact their ownership might have on the bank's future. Okay, so we're back, and we're finally ready to tackle this shareholding pattern. It's time to see who's really in charge at SBI.
It's like figuring out the power dynamics, right? Who has the influence and what are they trying to do?
Exactly. So first up, we've got the promoter controlling entities. In this case, it's the Indian government. They hold a big chunk of shares, something like 57.51%.
Yeah, that's a pretty big chunk.
It is. Pretty typical for public sector banks in India, right?
Yeah, usually the government keeps a controlling stake. It's part of how they try to make sure the financial system stays stable and that things are fair for everyone.
Right, so SBI isn't just about making as much profit as possible. They also got to think about what's good for the people of India. But how does all this government ownership affect how SBI makes decisions? Does it make them more careful, or does it actually give them the confidence to take bigger risks?
Well, it's kind of a balancing act. On the one hand, having the government as the main owner can make things more stable. Lenders feel more comfortable doing business with SBI because they know the Indian government is behind them.
I see.
But it can also create a lot of red tape, and sometimes there can be conflicts of interest.
Interesting. So it's not always a good thing or a bad thing. Now let's see who else is involved. We've got FIIs and DIIs. They're holding about 21.82% together. And then the rest, 20.67%, is held by the public. What do you make of that breakdown?
Well, the fact that FIs and DIIs are owning more and more of SBI shows that big institutional investors are getting interested. These are usually huge investment firms with a lot of money to invest, and they tend to think long term.
Makes sense.
Having them involved can bring in money, expertise, and they often push for better corporate governance.
So it's usually a good thing to have those institutional investors on board. It shows they think SBI is a good long-term bet. But what about the public stake? It's not that big. Does that tell us anything about how regular people view SBI as an investment?
It's tough to say for sure just by looking at how much the public owns. There could be lots of reasons why regular investors aren't holding as much SBI stock. Maybe they just don't know much about it, or they prefer to invest in other things, or maybe they're a little worried about the government's influence. And it's important to remember that a lot of people in India bank with SBI.
Yeah,
How they feel about SBI as a bank might be different from how they feel about it as an investment.
good point. Just because you use a bank doesn't mean you think it's a good investment. Before we move on from ownership, are there any warning signs or good signs you look for in a company's shareholding pattern? What should investors be paying attention to?
One thing that can be a problem is when one person or a small group owns way too much of the company. That can create conflicts of interest and make it hard for other shareholders to have any say. On the flip side, it's good when there's a mix of owners, institutional investors, regular people, and maybe even some strategic partners. That can lead to better decision making and more long-term value for everyone.
So it's like anything else. Diversity is good. Having different voices is important. Okay, we're running out of time, but we can't wrap up without at least mentioning these ratios. They can be a bit intimidating, but they really help us cut through all the clutter and get a clear picture of how healthy SBI is financially. Where do we even start?
I know they can seem complicated, but really, ratios are just tools to help us understand a company's performance. Think of them like financial x-rays. They let us see inside SBI's operations.
All right, let's put on our X-ray goggles. We've already talked about some key ratios like the PE ratio, the interest coverage ratio, and the return on equity. What are some other important ones to look at when we're evaluating a bank?
Well, for banks, some of the most important ratios have to do with profitability, asset quality, and capital adequacy. We've already talked about profitability with ROE, but there's also the net interest margin, or NIM, and return on assets, or ROA. These basically tell us how efficiently SBI is making money from lending, its main business.
So we want to see good NIM and ROA numbers. That means SBI is doing a good job managing its interest rates and making a profit from its assets. What about asset quality? What ratios can help us figure out how healthy SBI's loans are and how well they manage risk?
The big one there is the gross non-performing assets ratio, or GNPA. It tells us what percentage of SBI's loans are considered non-performing, meaning they're not being repaid as expected. Lower is better, of course. It suggests they're making good lending decisions and that the risk of losses is lower.
So we want to see SBI keeping those bad loans under control. Now, what about capital adequacy? We talked earlier about how important it is for banks to have enough capital to absorb potential losses. How can we use ratios to measure that?
The most common ratio for that is the capital adequacy ratio, or CRR. It's sometimes called the capital to risk-weighted assets ratio, or CRR. Basically, it compares SBI's capital reserves to its risk-weighted assets. A higher ratio means they're in a stronger position financially and more likely to be able to handle tough times.
Right, so a higher CRR means SBI is better prepared for whatever might come their way. I know we could go on and on about all the different ratios, but let's get to the point. Based on what you've seen from SBI's ratios, how healthy are they financially? Anything that worries you or makes you feel good?
Well, it's a bit of a mixed bag, to be honest. The good news is that their CIR is strong, which means they're in good shape when it comes to capital adequacy. And their NIM has been pretty stable lately. But their GNPA ratio, even though it's getting better, is still a bit higher than some other banks. And their ROA has been struggling a bit because of competition and rising costs.
So there are good things and not so good things. But it doesn't sound like a disaster. It seems like SBI has a pretty solid foundation, but there's some challenges they'll need to deal with that could affect their profitability down the line.
Exactly. And that's the thing about ratios. They're helpful, but they don't tell us everything. We have to think about them in the context of SBI's history, their strategy, who they're competing with, and what's happening in the overall economy.
Right. It's about seeing the big picture. Now, before we go, I want to come back to those contingent liabilities, that huge number we talked about earlier. You said it's something to watch. But what could it mean for SBI in the long run and for the whole Indian financial system?
That's the million-dollar question, isn't it? Contingent liabilities are basically potential risks that could turn into real problems in the future. And if enough of them were to happen at once, it could really strain SBI's resources. It could even have a domino effect on other banks in India and maybe even the whole economy.
Wow, so it's not just about SBI. It's about the whole financial system. That's a little scary, isn't it? It seems like what started as a look at one bank's stock has turned into something much bigger.
It definitely has. SBI's story is really tied to the story of India's economic growth. To understand one, you have to understand the other.
Well, I think we've given everyone a lot to think about today. We've gone through SBI's history, looked at their finances, and found some interesting clues about what the future might hold. But like any good detective story, there are still some mysteries to solve.
And that's what makes investing so interesting. It's a continuous process of learning and analyzing. We have to keep asking questions, be curious, and be ready to change our minds when new information comes along.
That's a great way to put it. And on that note, we'll leave you with one last thought. What other clues are hiding in SBI's financial statements? What can you learn by digging deeper, looking at their competitors, and seeing how they do over time? You might be surprised by what you find. Thanks for joining us on this deep dive into the world of SBI. Until next time, happy investing.